Your financial institution doesn't physically store your deposits. I want you to comprehend this concept before I elaborate on current financial systems. The funds you've placed in your checking account, your savings account, your certificate of deposit, your financial institution doesn't physically retain them. They've extended these funds as loans. They've allocated them to investments. They've utilized them to create returns for their company owners. What they maintain on premises is a percentage, a minimal percentage. And the present situation within the banking framework should be of interest to every American who maintains a bank account. I will guide you through the 4 tiers of exposure currently affecting your finances. Then I will demonstrate the 3 financial strategies I am currently implementing with my personal funds to maintain security. And in conclusion, I will reveal something most financial consultants rarely discuss: how to organize your accounts to receive comprehensive FDIC protection. Continue watching because this information alone could preserve hundreds of thousands of dollars if an unstable bank collapses at an inopportune time. Let us begin with the fundamentals because most individuals have never been properly educated about banking operations. Tier 1, Fractional Reserve Banking. When you enter your bank and deposit $100, you likely presume that $100 is stored in a secured facility with your identification on it, that the bank is safeguarding your money, that when you return next week or next month or next year, your $100 will remain exactly where you deposited it. That isn't what occurs. Not remotely close. Under the fractional reserve banking methodology, your bank is permitted by regulations to lend the majority of your deposit immediately after you provide it. They might retain $3, they might retain $10. The remainder is distributed as mortgage financing, vehicle financing, commercial financing, and investment vehicles. Your $100 transforms into someone's mortgage installment. And when that individual deposits the payment into their bank, that institution lends most of it again and continues repeatedly. This is referred to as the monetary multiplication effect. Your initial $100 deposit can generate $800 or $900 worth of lending throughout the banking network. The banks earn from the interest on each of those loans. You receive a minimal percentage in your savings account. They receive the differential on everything additional. Now, this framework has existed for hundreds of years and functions adequately under one stipulation. That stipulation is public trust. As long as depositors trust their money is secure, as long as panic doesn't develop, as long as withdrawals proceed at a standard pace, the calculations function. The bank consistently maintains sufficient currency to accommodate customers who visit on any particular day. But when trust deteriorates, the system deteriorates with it. And we needn't reference the Great Depression to observe this phenomenon. We witnessed it in 2023. Silicon Valley Bank was the 16th largest financial institution in the United States. $48 billion in deposits were withdrawn within a single day. $48 billion in 24 hours. The institution had been functioning for 40 years. It dissolved in 72 hours. First Republic Bank, over $100 billion in deposits, departed in the first quarter of 2023 alone. The institution was acquired by regulatory authorities and transferred to J.P. Morgan Chase, Signature Bank. Similar circumstances. Customers lost confidence. They withdrew their money. The institution couldn't fulfill the withdrawals. It collapsed. 3 banks over $500 billion in combined assets disappeared within weeks. And here's the consideration that might cause concern. In March of 2020, the Federal Reserve implemented a decision that most Americans never learned about. They eliminated the reserve requirement entirely. Previously, banks were mandated to maintain at least 10% of certain deposits in reserve, 10 cents on every dollar. Not substantial, but something. The Federal Reserve reduced that requirement to 0. Banks aren't currently required to maintain any minimum percentage of your deposits in reserve. None. That policy remains active today, currently, as you're viewing this video. So when I inform you your bank doesn't physically possess your money, I'm not overstating. I'm not being sensationalistic. I'm describing the regulatory structure under which every bank in America presently operates. Tier 2, Depositor Liability Provisions. Now let me explain what happens when a bank actually fails, because this is where most Americans encounter an unexpected reality. Most individuals have heard of government assistance. That's what occurred in 2008 during the financial crisis. Banks made problematic investments. They incurred billions in losses. And the federal government intervened with $700 billion of public funds through the Troubled Asset Relief Program, known as TARP, to support them. The public was dissatisfied. The banks survived. The taxpayers covered the expenses. What most Americans haven't heard of is depositor responsibility. Depositor responsibility is the opposite of government assistance. Instead of public money supporting the bank from external sources, the bank sustains itself from internal resources using depositor funds. Under the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, if a systemically significant financial institution is failing, regulators at the FDIC can initiate a process called orderly liquidation. During that process, the bank has the legal authority to transform depositor funds into bank ownership shares. Let me reiterate that for absolute clarity. The bank can convert the money in your account into shares of a struggling bank. You arrive with a checking account. You depart with ownership in a company that is approaching insolvency. That is depositor responsibility. Now, if you believe this is hypothetical, if you believe this has never actually happened, let me reference Cyprus in 2013. The Bank of Cyprus was struggling. The government and European regulators implemented a depositor liability measure. Depositors with more than 100,000 euros had 47.5% of their funds above that threshold converted into bank ownership. Nearly half of their money above the insurance limit was transferred overnight. People awakened and nearly half their accumulated savings was unavailable. Converted into shares of a bank that nobody desired to own, that wasn't distant history, that was 13 years ago in a developed Western-aligned economy, and a legal structure that permitted it exists in the United States currently under Dodd-Frank. Now here's the essential detail. Deposits under $250,000 per depositor per bank per ownership category are safeguarded by FDIC insurance. If your bank collapses and your balance is below that threshold, the FDIC intervenes and reimburses you, typically within several business days. That protection is genuine and it is significant, but anything exceeding that $250,000 threshold is classified as an unsecured claim against the bank. You're no longer a depositor at that point under legal definitions. You're a creditor. You're someone the bank owes money to. And creditors experience losses in a liquidation, sometimes considerable losses. If you have $300,000 in a single checking account at a single bank, $250,000 is protected. The remaining $50,000 is not. It enters the liquidation process. And in that process, you aren't first in priority. You aren't second. You aren't even near the beginning. Tier 3, the priority sequence. This is the aspect that might be concerning because when a bank fails, there exists a strict legal hierarchy that determines who receives payment first from whatever assets remain. And the American depositor is at the conclusion. At the very beginning of that hierarchy are derivative counterparties. These are Wall Street organizations and institutional investors holding sophisticated financial instruments. Credit default swaps, interest rate swaps, currency derivatives, collateralized debt obligations. These counterparties have what is termed super priority status under the Bankruptcy Abuse Prevention and Consumer Protection Act. They receive payment before everyone else, before bondholders, before other creditors, and before depositors. Now, let me provide a figure that contextualizes this perspective. The 5 largest banks in the United States, J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, and Morgan Stanley, collectively maintain over $200 trillion in notional derivative contracts. $200 trillion. The entire gross domestic product of the United States is approximately $29 trillion. The derivative exposure of just 5 banks is nearly 7 times the entire economic production of the country. In a standard environment, most of these derivatives counterbalance each other. They're hedged. The net exposure is a portion of the notional amount. But in a systemic crisis, when multiple counterparties simultaneously fail, when correlations deteriorate, when the hedges don't perform as anticipated, the gross exposure becomes relevant. And that exposure exceeds everything else on the balance sheet. Below derivative counterparties come secured creditors. These are lenders who possess collateral against their loans. Then come senior bondholders. Then unsecured bondholders. Then subordinated debt holders. And then at the very conclusion come uninsured depositors. Regular individuals with bank accounts above the FDIC threshold. You are final in sequence. Now, let me describe the fund that's intended to protect you. The FDIC's Deposit Insurance Fund. This is the financial pool the FDIC utilizes to reimburse depositors when a bank fails. As of the most recent reporting, that fund contains approximately $128 billion. $128 billion appears like an enormous amount until you compare it to what it's intended to cover. Total insured deposits in the United States exceed $10 trillion. The Deposit Insurance Fund covers approximately 1.2% of total insured deposits. 1.2%. If one mid-sized bank fails, the fund can manage it. If 2 or 3 regional banks fail simultaneously, the fund can probably manage it. But if we encounter a systemic crisis where multiple major institutions face difficulties simultaneously, the FDIC would need to borrow from the Treasury Department to cover the deficiency. And that borrowing isn't automatic. It requires political determination. It requires congressional endorsement. It requires decisions made under extreme pressure during a crisis. I'm not suggesting the FDIC will falter. The FDIC has never failed to protect insured deposits throughout its entire history since 1933, but I am indicating the calculations are close and the buffer is smaller than most realize. Tier 4, the revised regulations. And now we arrive at current developments. What motivated me to create this video? Because on March 19th of this year, 2026, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency collaboratively released a new proposal to revise bank capital requirements under the international framework known as Basel III. Let me clarify what Basel III represents and why it matters to you. After the 2008 financial crisis, international regulators agreed that banks needed to maintain more capital against their risks. Capital is the cushion that absorbs losses. The more capital a bank maintains, the more losses it can absorb before becoming insolvent. The more losses it can absorb, the less likely it is to fail. The less likely it is to fail, the safer your deposits are. Basel III is the set of international standards that dictates how much capital banks must maintain. It has been discussed, revised, and postponed for over a decade. In 2023, U.S. regulators proposed a version called the Basel III Endgame that would have significantly increased capital requirements for the largest banks. The proposal would have required the biggest institutions to maintain substantially more money in reserve against potential losses. The banking industry responded with the most aggressive lobbying campaign in recent memory. They invested hundreds of millions of dollars. They argued the rules would constrain lending. They said it would impact consumers negatively. They said it would decelerate economic growth. They pressured legislators. They inundated the comment period with objections. And it succeeded. The new proposal released on March 19th doesn't increase capital requirements. It decreases them. The largest banks, the globally systemically important banks, will experience a 2.4% reduction in required capital. Large regional banks get a 3% reduction. Smaller banks under $100 billion in assets get nearly 8% capital relief. Let me interpret that into straightforward language. In the midst of the most volatile global environment in decades, with oil prices advancing past $115 per barrel, with the Strait of Hormuz effectively restricted, with global stock markets experiencing their worst performance since the pandemic, with the United States actively engaged in a military situation. Regulators just informed the biggest banks in America that they can maintain less money against potential losses. Not more or less. The comment period for this proposed rule remains open until June 18, 2026. That is a 90-day public comment opportunity. You can visit regulations.gov and submit your comment. Tell the regulators your perspective about reducing bank capital requirements during a period of extraordinary global instability. Your comment becomes part of the public record. The regulators are legally obligated to consider it. Now, let me transition from the challenges to the solutions, because understanding the risk is only valuable if you know how to address it. Here are the 3 strategies I am implementing currently with my own finances. Strategy 1. Understand your FDIC limits and utilize every dollar of coverage available to you. FDIC insurance covers $250,000 per depositor per insured bank per ownership category. Most people hear $250,000 and believe that is the maximum they can protect at a single bank. That's incorrect. The key phrase is per ownership category. Here are the ownership categories recognized by the FDIC. Single accounts, joint accounts, revocable trust accounts, irrevocable trust accounts, certain retirement accounts, employee benefit plan accounts, corporation, partnership, and unincorporated association accounts and government accounts. Each of these categories receives its own $250,000 of coverage at the same bank. Let me demonstrate what this means practically. Say you are married. You have an individual checking account that is covered up to $250,000. Your spouse has an individual checking account that is another $250,000. You have a joint account together that is $250,000 per co-owner. So $500,000 total for the joint account. You have a revocable trust account naming your spouse as beneficiary. That is another $250,000. Your spouse has a revocable trust account naming you as beneficiary. Another $250,000. That is $1.75 million in FDIC coverage at a single bank for one married couple without opening an account at a second institution. If you add payable on death designations with multiple beneficiaries, the coverage expands further. Each unique beneficiary in a revocable trust or pot account adds another $250,000 in coverage. Visit the FDIC website at fdic.gov and use their electronic deposit insurance estimator. It is complimentary. You enter your account types, your beneficiaries, and your balances, and it calculates your exact coverage. Do this today, not next week. Today. If after organizing your accounts, you still have money above the FDIC limits, transfer the excess to a different FDIC-insured institution. The coverage resets at each separate bank. You can distribute your deposits across 3 or 4 banks and have every dollar fully insured. There is no limitation to how many banks you can use. Strategy 2. Diversify beyond the banking system entirely. This is the strategy that most financial advisors rarely discuss because it doesn't generate commissions for them. United States Treasury securities, Treasury bills, Treasury notes, and Treasury bonds are supported by the full faith and credit of the United States government. They aren't held at a bank. They aren't subject to depositor liability provisions. They aren't part of a fractional reserve system. They are direct obligations of the federal government. You can purchase Treasury securities directly through treasurydirect.gov. No broker, no intermediary, no fees, no commissions. You establish an account, connect it to your bank, and purchase Treasury securities directly from the United States government. Short-term Treasury bills, those maturing in 4 weeks to 1 year, are currently yielding over 4%. That is competitive with or better than what most savings accounts and certificates of deposit are paying. And your money isn't sitting on a bank's balance sheet. It isn't being loaned out. It isn't at risk in a depositor liability scenario. It is supported by the taxing authority of the United States government. For retirees, Treasury securities serve another important function. They are exempt from state and local income taxes. If you reside in a state with high income taxes, the after-tax yield on a Treasury bill can be significantly higher than the after-tax yield on a bank CD paying the same rate. I'm not advising you to withdraw all your money from banks. You need a checking account for daily transactions. You need liquidity for emergencies. But the portion of your savings that you aren't using day to day, the portion that is sitting in a savings account earning a minimal percentage, consider whether that money would be better protected and better compensated in Treasury securities. Strategy 3. Conduct a comprehensive review of every account you own. This is the step that requires the most effort but provides the most protection. Access every financial account you have, every checking account, every savings account, every certificate of deposit, every money market account, every brokerage account, every retirement account, every annuity, every life insurance policy with cash value, everything. For each account, answer these questions. What institution holds this money? How much is in the account? What type of insurance protects it? Am I within the coverage limits? And who is listed as the beneficiary? Let me explain why each of those questions matters. What institution holds the money? You need to determine whether your bank is FDIC insured. Most are, but not all. Credit unions are insured by the National Credit Union Administration, the NCUA, not the FDIC. The coverage limit is the same, $250,000, but the insuring entity differs. Ensure you know which one applies to each of your accounts. How much is in the account? You might be surprised how many people don't know their exact balances. Interest accumulates, dividends get reinvested, balances increase over time. An account you opened with $100,000 5 years ago might now hold $260,000. $10,000 of that is uninsured, and you might not even realize it. What type of insurance protects it? Bank accounts receive FDIC coverage. Credit union accounts receive NCUA coverage. Brokerage accounts receive SIPC protection, which differs from both. SIPC covers up to $500,000 in securities and $250,000 in cash if your brokerage firm fails. But SIPC doesn't protect against investment losses. If your stocks decline 50%, SIPC doesn't help. It only helps if the brokerage firm itself collapses and your assets are missing. Am I within the coverage limits? This is the calculation you need to perform for every single institution. Combine all your accounts at each bank by ownership category and compare the total to the FDIC limit. Do the same for credit unions with NCUA limits. Do the same for brokerages with SIPC limits. Who is the beneficiary? This matters for FDIC coverage because beneficiary designations can create additional ownership categories. A payable on death account with 3 named beneficiaries gets $750,000 in coverage at a single bank, $250,000 per beneficiary. If you haven't reviewed your beneficiary designations recently, do it now. Life changes. People get married, people get divorced, people pass away. If a named beneficiary is no longer living, that coverage category may no longer apply. Let me provide one more piece of information that most people don't know. If you have a retirement account at a bank, a traditional IRA or Roth IRA held in a bank CD, for example, that account receives its own $250,000 in FDIC coverage separate from your other accounts at that same bank. But if you have the same retirement account at a brokerage, it falls under SIPC coverage, not FDIC. The type of institution matters as much as the type of account. Here is the essential message. The banking system isn't designed primarily for your protection. It is designed for functionality. And it functions effectively when everything is stable, when confidence is strong, when markets are steady, when the global economy is predictable. We aren't in that environment currently. Oil is advancing past $115 per barrel. The Strait of Hormuz is effectively restricted. Global shipping is disrupted. Stock markets around the world are declining. The United States is engaged in an active military situation. And amid all of this, regulators just informed the biggest banks in America that they can maintain less capital against their risks, not more. I'm not advising you to panic. Panic is never a financial strategy. I'm advising you to stay informed. I'm advising you to understand where your money is, how it is protected, and what happens to it if something goes wrong because the regulations have changed. The reserve requirements are eliminated. The capital requirements just got reduced. The depositor liability framework is established. And the FDIC insurance fund covers 1.2% of what it is intended to protect. Knowledge is the only asset that cannot be compromised in a depositor liability scenario. It cannot be devalued in a crisis. It cannot be lost in a bank failure. And currently, the most valuable thing you can do with the next 30 minutes of your life is review your accounts, verify your FDIC coverage, and ensure every dollar you have earned throughout your entire life is protected. If this video helped you understand something about your money that you didn't know previously, subscribe to this channel. I analyze the financial strategies that genuinely matter. The ones that protect your family and your future, not the ones that make Wall Street wealthier. Share this video with someone you care about because the banks aren't going to inform them. The regulators aren't going to inform them. And by the time the news reports it, it will already be too late to act. I will see you in the next.